Chapter 1. A Brief History of Financial Time. Many of life's deepest questions, I have found, get asked over lunch. This particular midday meal occurred in 2000 at a Chinese restaurant in Manhattan, and my companion was a well-known hedge fund manager and contributor to the academic finance literature. We puzzled, as did many in finance at the time, over the historically high prices of stocks. What I cannot figure out, my friend began, is whether investors are really smart or really stupid. Seeing my puzzled expression, he continued, maybe the equity risk premium is still high, in which case prices will mean revert, which means that stock investors are really stupid. Alternatively, the equity risk premium has gotten a lot lower in the past 10 years, in which case prices will not mean revert, which means stock investors are really smart. Just what did he mean, and why was his question so important? Since my friend is really smart and has worked in finance all his adult life, I have to translate his question into plain English. In the past, stocks have had high returns because they have been really risky. But stocks are now so expensive that there are only two possibilities. Either they are going to fall dramatically in price and then have higher returns after that, in which case investors are stupid for paying such high prices now, or there will be no big fall in price and little risk, but returns will hereafter be permanently low, in which case investors are smart. So which is it? We both knew that the intelligence or lack thereof on the part of investors, from the humblest 401k participant to the titans of finance, was of secondary importance. Rather, my friend's question cut to the heart of the nature of investing, the interplay between risk and return. Sometime in the mid-1990s, people forgot about the risk-return nexus, and although the tech collapse of 2000-2002 briefly roused investors from their complacency, the damage was not deep enough, wide enough, or long enough to leave a lasting impression. By contrast, by 2009 investors were fully aware of financial risk, whether they remain awake to its nature for another generation, as they did after the market collapse of 1929-1932, or for less than a year, as they did after 2002, remains to be seen. However long the current turmoil lasts, it provides an opportunity to explore a radically altered investing environment. This book focuses primarily on the critical relationship between risk and return and what it means to investors in the current turbulent environment. In the beginning, in order to understand the story of risk and return, we need to travel back to the dawn of civilization. We can divide the millennia-old saga of investing into three parts: the development of loan capital, the development of equity, or stock capital, and the development of the capital markets themselves. From the beginning of human civilization, consumers have bought products from farmers and merchants, and all three have needed to borrow. In fact, the very first decipherable cuneiform clay tablets found in Mesopotamia, in what is now Iraq, primarily recorded production and business activity, and much of it consisted of credit transactions. Ordinary people often required credit to purchase food and shelter, farmers needed credit to buy seeds, tools, and both slave and hired labor, and merchants craved capital to outfit their trading expeditions with pack animals, ships, crew, trade goods, and currency. Like any other commodity, money has its price. What we recognize as money, stamped silver, gold, and copper discs, would not be invented until the late 7th century BC by the Lydians in Asia Minor. But no matter. Almost any widely traded commodity can fill the bill, and for thousands of years before the invention of coins, grain, silver ingots, and cattle served as capital that could be loaned by creditors and borrowed by debtors. To the ancient farmer, a bushel of seed grain or a head of cattle was capital enough. He could borrow them in one season and repay them, usually twice over, the next, a practice still observed in present-day primitive agricultural societies. At the origins of human agriculture, this investment return, referred to interchangeably as the cost of capital, or the interest rate, was 100% per growing season. Why this very high rate of return? It happened for at least two reasons. The first was supply and demand. So poor were ancient agricultural societies, so great was their demand for capital, and so little was the excess of it available for lending, mainly in the hands of wealthy farmers and businessmen, that the possessors of capital could demand a sky-high price for it. The second factor that drove up the cost of capital was that all loans were considered risky. In those days, an equivalent of the risk-free treasury bill T-bill did not exist, and every loan probably carried with it a significant probability of default. Not until the late medieval period did Northern European governments begin to offer very secure, risk-free, notes and bills. Which of these two factors, supply and demand or default risk, was the primary cause of the high rates? In my opinion, the supply-demand imbalance was the dominant one. Lenders have always demanded collateral in case of default, and in the ancient world, it could be draconian, the seizure of all of the debtor's property, or even his and his family's enslavement. These extreme measures offered lenders reasonable protection against default, and thus increased the supply of capital available to poor borrowers. Legislation that favors borrowers over creditors makes the latter less liable to lend, often causing more ultimate harm than good to the borrower. This is the essential trade-off of bankruptcy law. Over the centuries, with the gradual increase in wealth, capital became more abundant, and so its price, the rate of interest, fell. In the 3rd millennium BC, Sumerian borrowers paid 33% per year for loans of grain and 20% for loans of silver. A millennium later, the best Babylonian debtors borrowed silver at 10%. A millennium after that, the Greeks paid interest rates as low as 6%, and at the height of the Roman Empire, they fell as low as 4%. Just why have I spent the past few pages discussing this ancient history? After all, this is a book about modern-day investing. Because for every consumer of capital, there is, more or less, a provider of capital. That is where you, the investor, the provider of capital, come into the story. In the jargon of finance, the cost of capital to its consumers is exactly the same as the return to the investor, and as an investor, only by understanding the risks and rewards of the consumers of your capital can you truly understand the process. So far, I have been dealing with what is known in the modern era as debt financing. But throughout history, capital has also been supplied on another basis, which is through actual ownership shares, known today as equity financing, in which the owner of excess capital gives it to the businessman or merchant in exchange for a share of the assets and future profits of the venture. From the merchant or borrower's perspective, this is less risky than borrowing. If the merchant's venture fails, then he owes nothing beyond the investor's share of the residual assets of the venture, since there are no profits to distribute. But from the lender's perspective, providing equity capital is risky indeed, since he can lose capital more easily than with a loan. Further, the equity investor finds it devilishly hard to calculate the potential upside of an equity investment. It might be astronomical, it might be puny, or it might be lost entirely. In the modern world, most large firms gather both debt capital from banks or from bond issuance and equity capital from shareholders. The lenders of capital, the banks and bondholders, are paid off first. Only then do the equity shareholders, the residual owners, get what remains. The stock shareholder is last in line to receive the payoff from a business. This is a risky proposition, and thus deserves a higher return, on average, than that earned by the bondholders, who get their money back first. For these three reasons, the increased possibility of loss, the difficulty of estimating future profits, and the residual nature of equity ownership, a substantial return premium should be demanded by equity owners. This is the equity risk premium that my friend and I puzzled over that day at lunch. Because of the risks of equity ownership, it did not develop on a large scale until relatively late in history. True, since ancient times small enterprises often spread ownership among individuals, but the first joint stock companies did not see light of day until the medieval period. Around AD 1150, a water mill in Bouzical in southern France divided its ownership into shares. When the Paris Bourse opened in the 18th century, these shares traded actively until 1946, when that nation's socialist government, apparently lacking a sense of economic history, nationalized the company. Point 2. Around AD 1600, two much larger ventures, the English and Dutch East India Companies, hereafter referred to as the EIC and VOC, respectively, the latter by its Dutch initials, sold shares in their trading ventures, which were initially aimed at exploiting the fabulously profitable East Asian spice trade. The differences between the two companies spoke volumes about the power, wealth, and sophistication of these two nations, and about how investors were, and are, rewarded. At that time, England was a backward, weak nation with almost no functioning capital markets. Queen Elizabeth I, who issued the EIC's charter, was, by modern standards, a corrupt monarch whose revenue came mainly from rents on royal lands and the sale of monopolies to court favorites, most famously, the sweet wine franchise to Sir Walter Raleigh. Lenders to the crown demanded high interest rates to compensate for the risk that monarchs could, and frequently did, renounce their debts at will. Consequently, the cost of capital, that is, interest rates, in Tudor England were high. The lowest rates to high-quality borrowers with generous collateral were in the 10 to 14% range, while loan rates to riskier ventures and the crown were higher still. 3 The EIC, an even more uncertain enterprise, could not borrow capital at any price, nor could it even sell conventional shares. Instead, it was forced to offer fractional ownership in each annual expedition, return all of the investors' capital when the company's spice-laden ships returned from the East Indies, then raise capital all over again for the next expedition. Simply put, the EIC lacked permanent capital to sustain ongoing operations. Fortunately for its investors, the EIC expeditions proved hugely successful, often paying returns in excess of 100%. Always remember, investment return and the cost of capital for business ventures are flip sides of the same coin. These very high returns meant that British business ventures paid dearly for their seed cash. This is not the way to grow an economy or make a nation powerful. By contrast, the Dutch East India Company thrived in the Netherlands' sophisticated and trusted capital markets. By the late 16th century, its larger provincial governments and the best private borrowers got their capital at just 4% annual interest. When the VOC floated its stock shares, it was as permanent capital. The money was the company's to spend as it saw fit, and investors did not expect to see the initial investment back anytime soon, beyond a regular stream of profits as dividends. Dutch capital markets, with relatively low returns, a safer investment climate, and low-rate loans with which to fuel the nation's entrepreneurs, presented the mirror image to those in England, where investors earned higher returns but only at the price of higher risk. We now have two of the three elements in place needed to answer my friend's plaintive lunchtime question in the year 2000. Debt and equity capital, and the difference between the costs of the two, the equity risk premium. In order to give us some idea of what to expect in terms of risk and return, all that is needed is an appreciation of the markets where they trade. That debt and equity capital exist does not necessarily mean markets for them also do. The loan of a bushel of grain by one farmer to another in Mesopotamia in 2500 BC remained simply an agreement between these two men. Yes, the loan could be counted as an asset on the part of the lender, but it could not be easily sold by him to another investor. Likewise, until the establishment of the Paris Bourse, the owner of a share in the Bozical mill could not easily sell it to someone else, although apparently, shares were occasionally traded among private individuals. Near death in Venice. The real story of the capital markets begins in the 5th century AD, when the collapse of the Roman Empire in the west drove a small group of refugees to seek shelter. They found it in an island group situated in an obscure lagoon nestled in the northern corner of Italy's Adriatic coastline. This tiny city-state, Venice, prospered in the burgeoning maritime trade of the western Mediterranean. By the beginning of the second millennium, its galleys were filled with the most profitable commodities of the era: slaves and grain from the Black Sea, spices from East Asia, incense transshipped from Alexandria and Cairo, and a host of other luxuries from the far corners of the globe. Venice also found itself almost continuously at war with its more powerful neighbors and trading rivals, especially Genoa and the Ottoman Turks. In order to finance these conflicts, La Serenissima, the most serene republic, levied a curious kind of tax upon its wealthiest citizens, the prestiti. Prestiti were bonds issued by the state that yielded 5%. The Venetian treasury forced the rich to buy these securities, and their purchase was onerous because the going rate of interest was higher, about 6% in peacetime, and as high as 15 to 20% in the teeth of a crisis, when the treasury was most likely to issue them. Citizens paid the principal to a central treasury office, which then remitted periodic interest payments to their registered owners. The modern bond market was born when the treasury allowed owners to re-register these securities in someone else's name. Soon enough, what is now called a secondary market in prestiti arose, not only in Venice but in other nations as well. Figure 1.1 plots prestiti prices over the 2-century span between AD 1300 and 1500, and what a saga this graph tells. For the first 75 years of this plot, Venice enjoyed relative tranquility, and prestiti prices remained lofty, trading as high as par 100% of face value. As late as 1375, they sold at 92.5% of face value. Then, between AD 1377 and 1380, Venice fought a catastrophic war with Genoa. Initially, fiscal shock, not military defeat, damaged prestiti prices. The upcoming war expenditures forced the Republic to suspend interest payments and issue a massive amount of new bonds. This depressed their prices as low as 19% of face value at the conflict's onset. Worse followed. In 1379, the Genoese penetrated the lagoon, occupied Chioggia at its southern edge, used it to blockade La Serenissima, and nearly overran the island city. By 1380, when the city seemed about to capitulate, a daring last-ditch counter-blockade of Chioggia by the Venetians broke the will of the Genoese and forced them to retreat. 4. Figure 1.1 Price of Venetian prestiti AD 1300-1500. Source data. Sidney Homer and Richard Silla, A History of Interest Rates, Hoboken, N.J., John Wiley & Sons, 2005, 99, 107. Thereafter, Venice's military fortunes improved, but continued high military expenses meant equally heavy issuance of prestiti, which kept their prices in the secondary market relatively low for nearly a century until the Republic's debt was refinanced in 1482. Once again, just what does all this medieval history have to do with today's markets? Everything and more, for the history of the prestiti demonstrates, at a relatively early point in financial history, the close relationship between risk and return. Venetians who purchased prestiti at high prices in the secondary market during the calmest years earned the lowest returns. Contrariwise, those who bought at low prices when things looked the bleakest reaped the largest rewards. The brave soul who purchased prestiti in 1377 at a price of 19% of face value in the secondary market collected not only 26.3% interest, 5% divided by 0.19, but also a large dollop of subsequent capital appreciation as well. Of course, the risk that La Serenissima could have fallen to the Genoese, thus rendering the prestiti worthless, was substantial, hence the term risk premium. This roller coaster ride aside, the price series of Venetian prestiti was a relatively happy one, La Serenissima continued to issue debt and pay interest on it for more than 4 centuries after its near-death experience in 1377–1380. Among developed nations, recovery from military and economic travail is the rule, and very high returns are usually made by those brave enough to invest when the sky is blackest. Markets, however, do not always recover. Until World War I shut down the St. Petersburg Exchange in 1914, the Russian stock and bond markets were among the world's most respected and active. They never reopened. During the 20th century alone, military and political upheaval rendered not just St. Petersburg's bourse, but also many other once vigorous securities markets, defunct, or at least moribund, Cairo, Bombay, Buenos Aires, and Shanghai, to name a few. For the past 200 years, things have always worked out well in the long run for the owners of U.S. stocks. History shows that it is entirely possible that our luck will run out one day. Here's the central question for today's investor: are we in Venice in 1377, or in St. Petersburg in 1914? In most aspects, today's financial markets resemble the former. They are indeed distressed, and for good reason. Although there is every probability that the world economy, and the securities markets along with it, will recover and provide courageous investors with high returns, as did Prestiti in 1377, it is also possible that things will turn out worse than most predict. We just do not know for certain. Again, this is the very definition of a risk premium, the reward for bearing the risks of the unknown. Further, the greater the perceived risk, the greater the reward if things eventually turn out well. The incredible shrinking risk premium. 8 years after lunch with my friend in the Chinese restaurant, the markets seemed to have answered his question with a vengeance. Stock investors had indeed been stupid because they did not learn the lesson of just how risky even the seemingly safest assets can become, and even more critically, for accepting a low equity risk return premium for taking those risks. In 2000, many finance professionals did indeed grasp the shrinking equity risk premium. Unfortunately, many of them, particularly my friends' brethren in the hedge fund world, made a fatal mistake. Since risk premiums were low, they reasoned, the only way to earn higher returns was by borrowing large amounts of capital to multiply, leverage, in financial parlance, those paltry premiums. As so elegantly put by the Dean of American Financial Writers, James Grant, in a slightly different context. Imagine a man at the top of a stepladder. He is up on his toes reaching for something. Call that something, yield. Call the stepladder, leverage. Now kick the ladder away. The man falls, pieces of debt crashing to the floor around him. 5. Summary. Throughout history, there have always been providers and consumers of capital, today it is no different. Also throughout history, that capital has taken 2 basic forms: loans including bonds and equity partnership or stock. The latter has a lower legal standing than the former, and it is thus riskier and necessitates a higher long-term return to attract investors. During times of great social, political, and military turbulence, the prices of both stocks and bonds usually decline precipitously. Most often, this sets the stage for high future returns. Less frequently, however, the losses can be permanent and even total. Financial history demonstrates vividly the fact that just because this has not happened in the U.S. stock and bond markets yet is no guarantee that it might not occur in the future. Chapter 2. The Nature of the Beast. No balls, no blue chips. Old Wall Street adage. If you learn nothing else from this book, it should be that risk and return are inextricably intertwined. In almost every country where economists have studied securities returns, stocks have had higher returns than bonds. 1 Further, if you want those high stock returns, you are going to have to pay for them by bearing risk. This is a polite way of saying that in the course of earning those higher returns, your portfolio is going to lose a truckload of money from time to time. Conversely, if you desire perfect safety, then resign yourself to low returns. It really cannot be any other way. Of ravens and returns. Let's start our journey through the land of risk and return by imagining a clear, crisp winter afternoon in the halcyon days of late 1998. You are out for a stroll, and as your thoughts turn to your financial health, your mood elevates. Your portfolio, which consists of a mix of judiciously picked stocks and bonds, has doubled in value during the roaring bull market of the past 4 years. While you have not done as well as your acquaintances, who are flush with .com options and aggressive tech funds, your modest portfolio has landed you squarely on the road to a comfortable retirement. Suddenly, a winged creature lands on your shoulder. Ah, you say to yourself optimistically, the bluebird of happiness. Well, no, closer inspection reveals plumage of a darker hue. Hello, it intones gravely, I am the raven of capital market disaster. This somber omen does not bring glad tidings. No, not at all, it warns you that within the next decade, there will be not 1, but 2 historic market collapses. On each occasion, the broad market indexes will be cut approximately in half. O wise black bird, you implore, please tell me when these 2 calamities will occur, so I may avoid grievous losses. You swear you see a smirk on its beak as it flies off silently. Indeed, the raven got things exactly right. In the next 10 years you would suffer not one, but two of the 5 worst bear markets in the past century. Table 2.1 shines a bright light on these 10 years, showing returns for these 2 bear markets, plus the entire decade from 1999 to 2008, for some major classes of stocks and bonds. The table illuminates the landscape of risk and return for the decade between 1999 and 2008. It displays a lot of data, so let's explore them column by column. The first column simply lists the asset classes we are examining. The first 12 of them are the major foreign and domestic equity, that is, stock classes, separated by 3 different criteria: location, United States, foreign developed nations, and foreign emerging market nations, company size large versus small, and whether the companies are of the value or market type. The market designation means the broadest measure of stocks, which tend to be dominated by expensive glamorous companies, while value means the cheapest, least liked companies that consequently sell for low prices. Suffice it to say, this is the way that many finance professionals categorize stocks. The final 2 rows list different fixed income, that is, bond asset classes, generally perceived as being reasonably safe. Table 2.1 total returns of various stock and bond asset classes 1999-2008. Source data. Dimensional Fund Advisors, Barclays, Lehman Brothers. The second column tabulates the return of these asset classes during the 2000-2002 bear market. The 5 years immediately preceding this, from 1995 to 1999, saw what was arguably the biggest stock bubble in the history of mankind. Investors went so gaga over the potential of the internet that they regularly threw millions, and sometimes even billions, at 20-something entrepreneurs with only the vaguest of business models. Simply adding .com at the end of a drywall company's name could double its stock price. This madness also inflated the prices of the world's largest growth companies, which investors saw as the wired world's primary beneficiaries. Every other stock asset class languished. Real estate, represented by real estate investment trusts' rights. Bricks and mortar businesses were obsolete. Small banking, manufacturing, retail concerns, toast in the new economy. As 2000 wore on to 2001 and 2002, the dot-com comets gradually burned through their cash and went broke, at first one by one, then en masse. The composite index of the over-the-counter NASDAQ market system, where the shares of nearly all of the new firms traded, fell by over 3/4 and the S&P 500 fell by nearly half. But as seen in the second column, small stocks, value, that is, unglamorous stocks, and rights, which did not participate in the madness of the 1990s, held up very nicely, thank you, during the 2001-2002 bear market, with rights enjoying mid-double-digit positive returns. The more recent bear market, shown in the third column, was an entirely different kind of grisly. While the 2000-2001 decline was triggered when overenthusiastic tech companies ran out of cash, the current one began when overenthusiastic consumers ran out of credit. Furthermore, whereas the market froth of the 1990s confined itself mainly to tech stocks, the S&P 500, and its foreign equivalent, the Europe, Australia, and Far East EAFE index, by 2007 all stock asset classes had become overpriced as prices ran up dramatically in nearly every nation. Consequently, every stock asset class experienced similar severe declines. In 2000-2002, a few stock asset classes provided shelter from the bear, not so in 2007-2008. The final column of Table 2.1 delivers the punch line. Even though our prescient bird correctly warned you about the 2 calamities that struck the markets between 1999 and 2008, it would not have helped over the whole decade. Fully 8 of the 12 stock asset classes in Table 2.1 beat safe bonds during that period, as would have most reasonably diversified portfolios split among the 12. Had you heeded the Raven's warning and avoided equities entirely over the next decade, you might have missed the salutary returns of a well-diversified portfolio. Worse, you would now be faced with the problem of when to buy back into stocks. Diversification among different kinds of stock asset classes works well over the years and decades, but often quite poorly over weeks and months. The last column of Table 2.1 also gives the light as something often heard today: diversification does not do any good. True, on a day when the US market is down 5%, the rest of the world will follow, usually with even larger losses, and in a year that the S&P 500 is down more than 40%, most other asset classes may do just as poorly, if not worse. Investment wisdom, however, begins with the realization that long-term returns are the only ones that matter. Investors who can earn an 8% annualized return will multiply their wealth tenfold over the course of 30 years, and if they have half a brain, they will care little that many days, or even years, along the way their portfolios will suffer significant losses. If they are, in fact, anguished by the bad days and years, they can at least comfort themselves that the rewards of equity ownership are paid for in the universal currencies of financial risk: stomach acid and sleepless nights. History versus math. A familiarity with these sorts of short and intermediate-term returns allows the prudent investor to understand the risks of stock ownership. Much has been made lately of black swans, rare and supposedly unexpected events that roil society and the financial markets. In the world of finance, the only black swans are the history that investors have not read. Anyone familiar with the events of 1929-1932, which saw stocks fall by almost 90% in value, let alone what happened to the St. Petersburg Exchange after 1914, would not have been dumbfounded by the recent market decline. Point 2. The historical record, however, does not help as much with the most important exercise in the investment process, estimating future returns. Investors who cannot approach the expected return problem rationally and systematically are better off putting half of their money under the mattress, then lighting the rest on fire and throwing it out the window. The good news is that estimating future returns is not that difficult. In spite of this, many investors, even some accomplished academicians, do lean heavily on past returns to gauge future ones. This is a mistake. Perhaps you have seen a table that illustrates the nearly unimaginable wealth produced by long-term investments in large stocks and small stocks yielding annualized returns of nearly 10% and 12% per year, respectively, since the end of 1925. Well, you cannot have those returns. In fact, no individual in the history of the world ever has, or likely ever will. First, these returns are theoretical, that is, they incurred no broker's commissions, bid-ask spreads, the difference between the buy and sell price of the securities, or taxes on capital gains and dividends. They assume away spendthrift heirs, who over the 3 or so generations covered by this period would surely have vaporized the assets. Last, and most importantly, we cannot go all the way back to the end of 1925, when U.S. stocks yielded 5%. In fact, using historical returns to estimate future ones is an extremely dangerous exercise. It is even more dangerous to base financial planning decisions on the post-1925 database, a common zinger committed by many researchers and finance writers. The two best examples of the pitfalls of an over-reliance on historical returns arose in the early 1980s with bonds and in the late 1990s with stocks. The years following World War II were extraordinary in many respects. The most notable feature was the gradual acceleration of inflation, during which long-term bonds underwent a grinding bear market of historical proportions as interest rates rose along with the hyperinflation of the 1970s and 1980s. Inflation devastates long-term bonds, since their payments and final principal repayment are in nominal, or current, dollars. If an investor buys a 30-year bond yielding an initial 5% coupon, and long-term interest rates subsequently increase to 10%, the value of that bond temporarily falls by nearly half. During the 30 years between 1952 and 1981, long-term Treasury bonds returned just 2.33% on an annualized basis during a period in which inflation averaged 4.31% per year. Thus, on average, bond investors lost 2% of their purchasing power each year, even after reinvesting their coupons. Stocks, on the other hand, do relatively well during long periods of inflation, since companies can raise the prices of the goods and services they sell. During the same period, the S&P 500 returned 9.89% per year, more than 5% better than inflation. In short, by 1981 the typical bond investor had been pulverized by the horrid past, or realized, returns of bonds. Investors and finance journalists alike labeled these securities as certificates of confiscation, frightening off an entire generation of bond buyers. Yet, anyone who could add and subtract was presented with this calculus. On September 30, 1981, the government sold 20-year Treasury bonds yielding 15.78% interest, while during the previous 5 years inflation averaged only 10.11%. Further, by that point, the Federal Reserve, under the greatest of its chairman, Paul Volcker, had dramatically tightened the money supply. By 1981, this had the desired effect of lowering the inflation rate. Over the next 5 years, it fell to just 3.42%. To summarize, by the beginning of 1982, bond investors had been hammered. However, a dispassionate look at bond interest yields and a reasonable estimate of future inflation suggested high returns ahead, at least 5% on a real basis. This hard-headed assessment was indeed borne out. Over the 20-year period beginning in 1982, the real return of the long Treasury bond was in fact 8.66%. Another example of the dangers of an overemphasis on historical returns occurred in the late 1990s, as the prices of .com and tech stocks, along with large-cap growth stocks, soared into the stratosphere. Over the 74-year period between 1926 and 1999, the U.S. stock market provided investors an average return of 11.35% before inflation and 8.02% after inflation. Between 1995 and 1999, it clocked an astounding annualized 28.56%. Needless to say, the mood among equity investors was ebullient. In 1999, a popular mantra asserted that, every penny you don't have invested in stocks will hurt you, while one of that year's personal finance bestsellers was entitled Dow 36,000. Sadly, this was not how things played out. How, then, can we reasonably assess future returns? First, let us admit the obvious: unless we possess a crystal ball, we cannot do so with a great degree of accuracy. The best that we can do is to come up with what financial economists call an expected return, one of the most important concepts in finance. In order to understand this term, start at a roulette table in Monte Carlo, with 37 pockets numbered 0 through 36. In America, there is a 38th double zero pocket. The payoff on a winning dollar bet is $35, with a 1 in 37 chance of winning. On average, you will lose 5.3 cents of each dollar you bet minus 1. This is the expected return of each roll, and also of the total amount you bet in any given period of time. Of course, on any given night, you may get lucky and make money or have a string of bad spins and lose more than 5.3%. This is the realized return. The expected return is thus simply the best guess of what your realized return will be on an average night. Stocks and bonds work the same way as the roulette table, except that the expected payoff is almost always positive. If it were not positive, no one would invest. It is still roulette, but now the investor is the house. He will never know precisely what Lady Luck will dole out, but he can make a pretty good guess of the payout, particularly over future periods of at least 2 decades. How do we do this? Begin with bonds. In early 2009, a 10-year Treasury note yielded just 2%. Since the government can print money if it has to in order to make good on its bonds, we were guaranteed to receive both interest payments and principal, so its expected return at that point was 2%. U.S. Treasury securities issued with a maturity of 1 year or less are called bills, from 1 to 10 years, notes, and over 10 years, bonds. Notes and bonds yield an interest coupon every 6 months. Bills do not; rather, they are issued at a discount and redeemed at par. The difference is their yield. Amazingly, in early 2009 the yield of 10-year bonds issued by the most solid American companies was about 7%. If all of these companies survived, then the expected return of a portfolio of such bonds over the next decade would also be 7%. Unfortunately, companies, including the most highly rated ones, do default and go bankrupt from time to time, so the actual return will be less than 7% after taking these failures into account. Just how much less than 7% depends upon just how many of these companies fail. If more than 5% per year do, then investors would be better off owning the 10-year Treasury note. Most experts would estimate the long-term bankruptcy rate of such highly rated companies at no more than 1% per year, but in the present environment let's be overly conservative and call it 2%. In that case the expected return of high-grade U.S. corporate bonds would be 5%, the 7% interest coupon minus a 2% failure rate. In Table 2.2, I have tabulated the range of possible outcomes. As already noted, only at a 5% annual default rate would investors be worse off than in treasuries. What are the odds of 1 in 20 of the most solid American companies going bankrupt every year for a decade? In a worst-case scenario, this might happen over the next year or two, but a decade of such failures would be a cataclysm far worse than even the Great Depression. Further, imagine that the loss is an astounding 4% per year, and we eventually wind up with a 3% return. Even though we earned a 1% excess return over treasuries, we would not be overjoyed, since that small margin would not be enough to compensate us for suffering from the risk, the stomach acid, of owning these securities. At a loss rate of 3%, corporate bonds are left with a 4% return, which is probably adequate to compensate us for the extra risk. Anything better than that is gravy. Table 2.2a hypothetical illustration of the risk premium of corporate bonds. Similarly, by the end of 2008 the bonds of companies of lesser financial strength, so-called high-yield or junk bonds, yielded 22.5%, more than 20% higher than treasuries. This daylight between the two, the junk treasury spread, was historically unprecedented. This meant that 20% of these companies would have had to go belly up every year in order to produce a lower return than treasuries of similar maturity. After 10 years, this would leave just 1 in 9 of them standing. What are the odds of a failure rate this high? Very low, but not zero. Once again, junk bonds must offer a return premium over treasuries to induce investors to buy these very risky securities. If that required premium is 5%, then in late 2008 up to 15% could fail each year in order to make their purchase worthwhile. The foregoing example assumes that the investor owns a very large number of these bonds, or a mutual fund that invests in them. Obviously, if an investor owns a small number of bonds, an unlucky draw could mean the default of all inside of 5 years. To recapitulate, a reasonable estimate of the failure rate for the highly rated companies might be in the range of about 2% per year, leaving a 5% expected corporate bond return. Assuming that the long-term inflation rate is about 3%, this leaves an inflation-adjusted return of about 2%. In late 2008, for the junk-rated companies, the risk premium, the excess return over a 2% treasury note, might have been as large as 10% per year, leaving an expected return of 12% on a nominal basis or 9% on an inflation-adjusted basis. The higher than treasury returns for high-grade and junk bonds described above are the rewards the investor would have reaped for bearing the risk that the economy and, along with it, the default rate could actually be much worse than expected. To repeat once more, the investor estimates the expected returns of bonds simply by starting with the interest coupon, then subtracting out the failure rate. The relationship between risk and return is the single most important concept in this book. Recall that if 10-year corporate bonds yield 7%, but 5% of them per year fail, leaving us with the 2% treasury return, this is not even Steven. No, not even close. The corporate bonds churned our stomachs and kept us awake at night, whereas the T-note holders slept like babies. Corporate bondholders need to be paid a risk premium in return for their attendant insomnia and upset tummies. It follows, then, that the greater the risk, the higher the risk premium should be. In fact, the single most reliable indicator of fraud is the promise of high return with low risk. Bernard Madoff's modus operandi involved only a slight variant on this theme: moderate returns with no risk. Nor was this the only sign of fraud. All securities investments involve three operations: advising, brokerage, and custody. In any well-run, above-board investment operation, all three are conducted transparently. By contrast, Mr. Madoff conducted all three behind tightly locked doors. This point about risk and return is so critical that I am going to repeat it yet one more time. Investors cannot earn high returns without occasionally bearing great loss. If the investor desires safety, then he or she is doomed to receive low returns. Mr. Gordon's curious equation. With stocks, the estimation of future expected returns is the same, except that we start with the dividend yield, then add the growth rate of those dividends. Imagine that a company sells at $100 per share and pays a $3 dividend, or 3% of the share price. This $3 yield is money in the investor's pocket, to reinvest in the stock of this company or in any other financial asset, or to spend on groceries or BMWs. Now suppose that the company grows its business, and thus its dividend, by 4% next year, from $3 to $3.12 per share. Since the market values the share price according to the 3% dividend and that dividend has gone up by 4%, in an ideal world the share price also goes up by 4%, to $104. Thus, we reap a 7% return, the 3% dividend plus the 4% increase in share price. The same goes for the entire stock market. In early 2009, the U.S. market yielded a 3% dividend. How fast does that dividend grow? Financial historians happen to have very good long-term data on that question. Figure 2.1 plots the per-share dividends on the S&P 500 stock index since 1871. Notice how slowly they grew before about 1940, then rose more rapidly after that. Figure 2.1 nominal per-share dividends of U.S. stocks. Source data. http://www.econ.yale.edu//data/e_data.xls. The increase in growth rate after about 1940 is an illusion, as most of it resulted from inflation. The shallower slope before 1940 better represents the true growth rate. When the dividends in previous years are converted into $2008, a more accurate picture emerges, as shown in Figure 2.2. The inflation-adjusted dividends of the U.S. stock market increase at an agonizingly bumpy and slow 1.32% per year. This illustrates another important rule of finance: always think in after inflation, or, real, terms. This avoids having to correct later for the effect of long-term inflation. In the end, focusing on real returns streamlines thinking and helps investors tune out the noise they will hear about how inflation corrodes wealth. The U.S. economy grows, on average, about 3% per year in real terms, and total corporate profits grow along with it at roughly the same 3% long-term real rate. Why do per-share dividends only grow at slightly more than a 1% rate, and not at the 3% rate of the overall economy? Because companies, like people, are born, live, and die, and new companies replace them. Investment bankers, bless their souls, sell the shares of these new companies at initial public offerings (IPOs), and these new shares dilute the existing pool by, on average, about 2% per year. So even though earnings grow by 3% per year, this 2% growth in the number of shares leaves only about 1% growth in per-share dividends. Yes, companies do buy back shares, but the 2% dilution takes these buybacks into consideration. Point 3. Figure 2.2 inflation-adjusted per-share dividends in $2008 of U.S. stocks. Source data. http://www.econ.yale.edu/tilde schiller/data/e_data.xls. Similarly, brokerage houses and mutual fund companies often tout the stocks of emerging market nations, such as Brazil, Russia, India, and China, the so-called BRIC countries, because of their rapid economic growth. But beware, share dilution, and often outright theft because of lax security laws, vaporizes a lot of this growth by the time it reaches the per-share level. For example, China's economy has been growing at a blistering 9% real rate per year for more than 2 decades. Yet between 1993 and 2008, investors actually lost 3.3% per year in Chinese stocks, even with dividends reinvested. You read that right. Over this 16-year period, even before expenses, the investor in Chinese stocks lost 41.5% of value. 4. The loss of 3.3% per year before inflation calculates out to a loss of 5.7% per year after inflation. Do not trust historical data, especially recent data, to estimate the future returns of stocks and bonds. Instead, rely on interest and dividend payouts and their growth failure rates. Table 2.3 shows that the same is also true, to a lesser extent, for the smaller, tiger, nations of East Asia, Indonesia, Korea, Malaysia, Singapore, Taiwan, and Thailand, all of which had lower equity returns than the more slowly growing economy of the United States. We can now finally estimate the real expected returns of equities. As we have already seen, in the case of the S&P 500, it is as easy as adding the approximately 2.5% current yield of this index to the 1.32% real dividend growth rate to get an expected real return of slightly less than 4%. This simple computation, simply adding together the dividend yield and growth rate, is known as the Gordon equation, and it appears repeatedly throughout this book. Table 2.3 Good economies, bad stocks. Source data: Morgan Stanley Capital Indexes, International Monetary Fund. Expected return equals dividend yield plus dividend growth rate. It would be nice if dividends grew more smoothly, and even better if stocks maintained their price so as to yield a constant 2.5% dividend, that is, to sell at precisely 40 times the dividend amount. Unfortunately, markets do not cooperate that well. Over the course of the 20th century, stocks have sold for as low as about 7 times dividends in 1932 and as high as 90 times in 2000. However, over the long run these fluctuations average out, and the above calculation serves reasonably well. Math detail: the discounted dividend model. Among early American economists, Irving Fisher towers above all the rest. Educated at Yale, where one of his advisors was the great physicist Willard Gibbs, he is best known for his infamous 1929 pronouncement, "Stock prices have reached what looks like a permanently high plateau." Which is too bad, because among his many accomplishments was the basic mathematical method for evaluating the value of any investment or possession, be it financial, physical, artistic, or even spiritual. His essential insight was that the market price is but a pale imitation of the real deal, the pleasure or income stream an asset delivers over time, discounted by the appropriate rate of interest for how far in the future each part of that income accrues. 5. For an immediately consumed item such as a dinner, the answer is evident. You do not purchase that meal for $5, $25, or $125 unless it provides you with that amount of sustenance and enjoyment. Next, suppose someone offers to sell you a meal listed on the menu at $25 for consumption 10 years hence. How much would you be willing to pay for it right now, and then have to wait a decade for it? Certainly much less than $25. Say you have decided that $5 sounds about right. Punch the numbers into a financial calculator and out pops an interest rate of 17.46%. That is your own personal, restaurant meal interest rate. Or you could work the problem backward, pick 15% per year as the interest rate, and calculate that you will pay $6.18 for it now. The key point is that a pleasure enjoyed today is almost always worth more than one enjoyed in the future. Fisher elegantly calls this the impatience for the item in question. It is synonymous with the rate of interest. Rare cases of negative item-specific rates of interest do exist. Perhaps you suspect that in 10 years the nation is likely to fall prey to war or famine. In that situation, you might very well be willing to pay a premium today for a meal 10 years hence. Probably the most common example of this involves fugitives from justice or persecution who purchase easily transportable jewelry, which they will likely have to sell at a loss to pay for their escape and refuge. Once storage costs and insurance are taken into account, holding gold or jewels becomes even less attractive. However, money rates of interest are never negative, since you can always get at least a zero yield by packing your dough into a mattress. People can have different impatience or interest rates for different items. Further, the rate for a given item depends on personal circumstances. A prosperous person is willing to spend much more today for a meal 10 years hence than a pauper. There are other intrinsic personal characteristics that determine impatience or rate of interest. Wastrels are by nature profligate and have high impatience, while thrifty people have low impatience. Accordingly, the value of a stock or bond is its future stream of income, and in the case of a bond, its principal repayment at maturity, all discounted by the appropriate rate to the present. Let's begin with a stock with a $3 dividend that is expected to grow at 6% per year. Let's further assume that the impatience of the investors, in the aggregate, for that money is 9% per year. Thus, the value of its future dividends, P, is. Or, more generally, where D equals last year's dividend, G equals dividend growth rate, R equals expected return, and P equals price. Applying a bit of integral calculus to the above equation, we come up with P equals D R G, which rearranges to R equals dP plus G, which is the Gordon equation, return equals dividend yield plus growth. Note that we have worked backward, using the price as the dependent variable and the return as an independent variable, then solving for the return. The reason for doing this is that when you are solving for the price, you may wish to assign a higher discount factor return to a riskier asset. What if the dividend yield changes over time? For example, between 1926 and 1999, the dividend on the S&P 500 decreased from 5% to 1.1%. This annualizes out to a price increase from this fall in dividend of 2.1% per year. By contrast, a rise in dividend implies a fall in price. Had someone known in 1926, for example, that over the next 73 years this would occur, and that dividends grew at a real rate of 1.3% per year, he could have computed that the real return over this period would be 5% plus 1.3% plus 2.1% equals 8.4%. Or, more generally, expected real return equals yield plus real growth rate plus annualized change in valuation. In actual fact, the real return of the S&P 500 over that period was 8.0%. Not too shabby. This does provide a useful adjustment to the expected rate of return calculated by the Gordon equation. 10 years ago, Vanguard chairman John Bogle was fond of pointing out that such low dividend yields were highly likely to mean revert, that is, return to more historical levels in the range of 3 to 4%. This meant that expected real returns would be negative, a prescient analysis if there ever was one. What now? Many observers feel that most asset classes are at least fairly valued, and that some, such as European stocks and REITs, are downright cheap. If these observers are correct and prices mean revert up, then returns should be even higher than calculated by the Gordon equation. To reiterate, the 4% expected return we have just calculated for stocks is a real return. This means that the value of the portfolio after taking inflation into account, its actual purchasing power, should, on average, double every 18 years, b. At the present time, many foreign equity markets yield around 5%. Even if their real per-share earnings do not grow at all, their real expected returns should be quite agreeable going forward, the 5% dividend. Similarly, the shares of REITs corporations that own and manage shopping centers, apartment houses, and other commercial property, yielded about 10% in early 2009. U.S. law mandates that these companies distribute at least 90% of their profits as dividends to shareholders, which accounts for the very high dividend. After paying out almost all of their profits to shareholders, REITs have very little capital left to purchase more properties or improve the ones they have. The gods of finance face them with an unpleasant choice: either borrow capital in the form of bonds and bank loans, or not grow. The first path may produce growth, but it is also highly risky, since being heavily indebted to banks and bondholders can leave them vulnerable in the event of a credit crisis, which is precisely what has happened to many of them in 2007 and 2008. So, in early 2009, the best real REIT return that investors could reasonably hope for was 10%. If substantial numbers fail over the next several years, or even if they grow more slowly than in the past, this return could be lower. As this is being written, REIT dividend payouts are falling rapidly. If, and how much, they recover will in large part determine their future returns. Let's summarize this chapter's lessons thus far. In the past, investors could expect only low returns when investing in safe assets. Today, this rule applies with a vengeance to treasury bills, which currently have a near zero yield. Investors earn higher returns only by bearing risks, by seeking out risk premiums. To calculate the expected returns of bonds, start out with the coupon yield and subtract the annual rate of loss resulting from default and bankruptcy. Using the Gordon equation, simply adding the dividend rate to the growth rate, investors can estimate the approximate size of future stock returns. As already noted, the